a good discussion around the table, and I'd love to hear that there's actually a separate session spent on emerging risks, and it's all in hand. But certainly some of our research shows that many organizations are really early in this journey. They've got the traditional risks managed, but the emerging ones not so much. And just think about it, they are complex, and perhaps getting at them in terms of the research and monitoring is different than the typical well-known risks. So it's probably understandable that this is a bit of a journey that we're on. Now, I want the stealth threat, I would call it, demographics, longevity. We've known this. Many have talked about the changing demographics. Day by day, we get older. We know birth rates across the country. And yet, all of a sudden, we run into a shock situation where we need to respond. So it clearly is an emerging risk that needs to get the right attention and profile at the board. And John, maybe I'll turn it over to you to give us a few thoughts on that area.
Thanks very much, Don. What I thought I might do is, first of all, separate this discussion into the two topics, one being demographics and the other one being longevity risk itself, and with particular focus on retirees or those approaching retirement, because that is where the real stress is starting to build in the world today, particularly for corporations and governments and individuals. In August of 2014, The Economist had an article out, and one of the comments that they made is, for the last 50 years, every forecast about how long people will live have fallen short. And despite the fact that there were fears of obesity, global warming taking place around the world, and the fact that that would therefore reverse the trend, life expectancy in most of the rich countries, in fact, has increased. The Globe and Mail had an article again in September just highlighting the results of a Statistics Canada analysis that was done based upon 2013 data. Just a few facts. Population of Canada in 2013 is 35.2 million, and by 2063 is expected to be 51 million. The number of seniors greater than 80 years of age are 1.4 million today, and in 2063 are expected to be 5 million. Seniors as a percentage of the population, 4.1% today, 9.6% expected in 2030, and to my mind a staggering 25% expected in 2063. I'm not going to be here to validate that number, but on the other hand, if it's true, there are some major issues, needless to say. The working age of the population between 15 and 64, 69% of those working today are in that bracket, and by 2030 that number is expected to go down to 60%. Other little tidbits: by 2014 the number of seniors in Canada could surpass the number of children. More than 1,000 people are retiring every day in North America, and life expectancy for both males and females is increasing, now into the low 80s. Cause of that being the fact that the baby boomers are more active in retirement, and as well there have been improvements in lifestyle and obviously medical technology. This will likely mean, however, that higher life expectancies will take place than those current generations of retirees. And finally, the other prediction that seems to take on more and more credibility each day is that low interest rate environment could last for many more years. We saw most recently the comments from the IMF about slow global growth. So what are the impacts of all of this? First of all, on individuals, you're dealing with the fact that longevity risk could get potentially very expensive. Longevity risk being the fact that you live longer than you were expected to live. Individuals in that boat are concerned about the adequacy of their assets to meet their income and health care needs. They have a combination of registered plans, such as registered retirement savings plans, and unregistered plans being savings outside of such registered plans. But health care costs are expected to increase, although in the United States, Bob, I understand the last few years they've been relatively flat. But who believes that health care costs will not increase? And the question really comes down to who's going to fund these. Will government continue to fund them? Will be a greater burden be put on individuals? Or will corporations be required to pay more to assist? Individuals with defined benefit pension plans, however, have a degree of comfort in that their payments are guaranteed through the pension plan, effectively by the corporations, being fixed amounts annually that they receive, usually adjusted by inflation. The trend, however, in corporate Canada has been a move to defined contribution plans, which have no corporate backstop and for which the longevity risk has now been transferred to the retirees. The corporations obviously are dealing, as we saw in the financial crisis, with situations where, due to the plunge of the value of assets in some of these pension plans, the need to top up the plans with further cash contributions to meet the expected liabilities. The trend is now taking place more so than ever, I would say, to transfer off some of that particular risk associated with the longevity of the employees to the life insurance companies. And we've seen examples such as General Motors, Verizon, and Rogers, for example, and others in Europe that have taken that particular approach. Governments face the risk of lower revenues due to retiring workers, or as well due to the reduced hours that seniors are working. There is therefore a need for an increased number of immigrants coming into the country to support the workforce, or as well a higher fertility rate. Both of these are designed to shore up government revenues and at the same time to provide the necessary workforce solutions. So insurers play a role in this, as I've indicated already in one instance. From an individual perspective, there are types of annuities that a retiree can take out, such as a fixed term annuity where you just get paid out the money over a fixed period of time. Life annuity, again, same principle, although obviously lower amounts until you die, and then the joint and last survivor annuity. And corporations, as I say, are already in the boat of transferring some of the longevity risk, the risk that their retirees will continue to live for a longer and longer period, thereby stressing the pension plans. They are transferring those as well to the insurance companies. The insurance companies, in turn, are looking at laying off some of that risk through reinsurance programs. But it's not just the world of the insurance companies. Private equity businesses are getting into this as well. One of the Sun Life sold off its U.S. fixed annuity business to Guggenheim Partners, who seem to feel that they can manage the investment side and the cost side better than we could. We were dissatisfied with the low ROEs and as well with the risk and the capital requirements of that particular business. But Guggenheim, I'm sure, expects to grow in that particular space. When you look at the Y generation, these are unlikely to have the support of a defined benefit plan. They must save more for investments, place more in marketable securities, and other type of investments that provide no guarantees or capital preservation or income flow. The question is, what can corporations do to assist the Y generation with their financial planning? This is all part of the war for talent and keeping people. So demographics, low interest rate environments, increased longevity risk, these are all challenges to individuals, corporations, and governments. Solutions are not without risk to any of the parties involved. So what's the impact of all of this on boards? Well, I think you have to take a look internally, and obviously your management is doing this all the time, but what do we do if we have a defined benefit pension plan? Those are getting fewer and fewer by nature in the private sector. But look at the issue of de-risking, particularly at this time with low interest rates. The second area is your human resource planning and succession. More and more people are working longer, and in some regards that is a consequence of not having enough to live on. But what impact does that have on your succession planning for some of the key positions? Executive compensation is another area that needs to be considered in light of this, and as well post-retirement benefits other than pensions, such as supplementary health care coverages. Secondly, boards need to be considered about the war for talent and how, in fact, are we going to retain and attract the best and the brightest? And to what extent can we assist them further in their retirement savings, given the fact that they may not have the comfort of any corporate support behind them? In terms of your business day-to-day, there's the product pricing, the distribution models that you've got to look at, and analyzing your data as a whole in light of a number of these developments. And finally, cannot underestimate, and particularly we do this in the insurance world, is the extent of stress testing and scenario planning that you do in recognizing some of the changes that are taking place not only in your home country, but as well in other parts of the world. So Don, that be my introductory comments.
So I'm just thinking about longevity risk. This should be good news for the individuals that they're living longer, but a huge risk in terms of how do we sustain a lifestyle, et cetera, consumption. I mean, there's major issues in